First of all, warm welcome to all of you. Thank you for joining us. This is our seventh session, and today we are finally moving into fundamentals. And previously, we were all talking about technical characteristics. So today we are talking about what fundamental characteristics do the winning stocks display before they make their big price runs. Uh, Today's session, my name is Arun, and joining me for today's session is Raghav, and we both of us together will be conducting the session today, just like last time. And before we start, and just please go over this disclaimer. So the purpose of this webinar is purely for educational purposes. What we are trying to show here is a certain methodology that we use in trying to pick our investments, and hopefully you will be able to apply this thinking and this methodology in your own when you pick your own stocks. So don't use any examples that we give here as it is. Rather, try to understand the methodology that goes into picking these stocks and apply them on your own. So before we start with the topic, we'll go over what the market has been doing since we met last time.
Yes. So it's been 2 weeks since we met last time, and markets have shown a lot of strength in the past 2 weeks. The last time when we met, we've seen that markets were consolidating a bit. Both the Nifty and Sensex, after reaching their all-time highs, they retracted marginally and they fell a bit off their highs around this time. But after that, markets have regained strength, and the Sensex has gained about 2.05%, while the Nifty has gained about 2.3%. And this was all because of these 3 days. In a span of about 3 days, the Sensex and Nifty have rallied 2.5%. Basically, the weak global cues were plaguing Indian markets for quite some time now. However, the global cues have faded a bit, and the focus has now shifted to earnings season. There have been a lot of positive earnings, while there was a fair bit of negative earnings as well. So the market are currently strong. In the last week, the Sensex has scaled 30,000 mark, and also the Nifty has crossed above the 9,300 mark. And they're marginally below their off highs. It is about under 1% of their highs. The similar strength is observed in mid cap and small cap indices. The mid cap index has gained about 4%, while the small cap has gained about 4.6% respectively. So the overall Indian market is in a confirmed uptrend. There are a lot of stocks that are breaking out of good patterns and making new highs. So investors are supposed to look out for stocks which are showing good fundamentals and look for a proper buy point before entering into a position. Meanwhile, we've also added about 5 stocks, while we've removed 9 stocks from our portfolio in the last 2 weeks. Moving on with the topic for today.
Okay, so here's a quick summary of all the things that we'll be talking about. Like as mentioned earlier, today is all about what to buy versus our prior sessions were more about when to buy, and it was all about timing. Today we are talking about how do we use the canceling methodology to pick our stocks. So we'll talk about what we believe is the number one factor in selecting any stock, and we'll talk about how a combination of strong earnings and sales growth can lead to a really good investment. And we'll go over P ratios a bit, and why exactly we don't give so much of importance to P ratios when it comes to buying decisions. And finally, we'll go over how do we apply this methodology with the MarketSmith India application to pick our stocks. Yeah, so today and the following 3 sessions will talk about how do we pick our stocks, the fundamental characteristics that we look for while we pick our investments. Of course, timing still remains important. When we pick the correct stock, we need to make sure that we buy it at the right time. So all those timing decisions, when to buy and when to sell, we had talked about in our prior webinars. So just to a quick recap of that, we always buy when the market is in an uptrend, and we always buy when the stock is breaking out of a particular base pattern. So, in case you were getting the idea that it's only about technicals, that's not really true. When it comes to stock picking, about 70 to 80% of the decision is based on fundamentals. So you have to be sure that you're buying the right merchandise in the market. So we'll talk about how do we identify the right merchandise, but it's the main, you should not ignore the fundamental aspect, and that makes a big difference in whether it's going to be a winning stock or not. Technicals do play a part, but the technicals come into play when we are talking about once we have identified what we want to buy, when are we going to buy it. Technical is used just to time the buy and sell decisions, whereas what exactly to buy is based only on the fundamentals. Okay, so earnings per share growth is what we believe is the number one factor when it comes to buying stocks. So, based on our study of the biggest winners in the US market since 1880, which covered 26 market cycles. So, one cycle would include a bull market and a bear market. So, covering 27 large market cycles, we see that earnings per share growth, the growth rate of earnings per share, is the biggest driver for a stock's price. So as long as it has great earnings per share growth, that correlates with strong price movements. So what we see is that the best stocks, the winning stocks, they show EPS growth before they make their big runs. So they will have great EPS growth in terms of quarterly growth as well. So each quarter they will have strong EPS growth, as well as on a more long-term basis. On a 3-year basis, they will have they will also have EPS growth on an annual basis as well. So we'll talk more over why exactly we emphasize that it has to be there on a quarterly basis as well as on an annual basis. So it comes down to the C and A in the Cancelim system. So C stands for current earnings, while A stands for annual earnings. So why do we look for both? Because we need to make sure that it has sound growth in recent years, and it has sound growth in the recent quarters as well. Now, it's not really a checklist to say that we want earnings growth currently and annually. There is a reason why we say this. So we say that 25% or higher is the EPS growth that should be there in the most recent quarter, and in the last, if you can find 25% or more in the last 2 quarters as well, so that's even better. So make sure that we are comparing when we talk about growth in earnings, we are talking about year-over-year growth. So for example, if we are talking about Q1 2011 or Q1 2017, we are comparing Q1 to Q1 in the prior year. So it's always a year-over-year figure that we are talking about when it comes to earnings growth, and as well annual growth is always going to be years over year. But when it comes to quarterly growth, we are always talking about this quarter compared to the same quarter in the prior year. Now, why do we say it should be 25% or higher? Now, that's because we want to be sure that this is a business that is working in the current economic environment. So, in the environment that exists right now in the market, this business is able to fetch very strong growth in earnings, 25% or more. So that if it is 25% or more, that means that it is a strong earnings growth. So you want to see that happen in the recent quarters. So why in the recent quarters? Recent quarters is telling us that this business is able to fetch profits in the current environment. And why annual? So we mentioned that we look at annual earnings growth as well. Annual earnings growth is going to tell us that this business is able to fetch earnings growth consistently over a decent period of time. So it's telling us that this is a business model that actually has been working for some amount of time. So now, when we say 25% or more, it's not all the stocks in the market will have this kind of growth. So when we set this kind of benchmark, we are really picking automatically. We're screening out a lot of stocks, and we're really picking out the ones that have the best growth. So it's not a huge percentage of the publicly traded stocks that will have 25% EPS growth in the most recent quarter. And if we can see accelerating earnings growth, that's an uh, even better indication. So if we can see that year-over-year growth for Q1, say year-over-year growth was 10%. In Q2, year-over-year growth became 24%. So that growth accelerated even further to 50% year-over-year in Q3, and then it became 72% year-over-year in Q4. So this is an example of earnings acceleration. So you see that each quarter, the pace of earnings growth is increasing. So this is something that we really like to see, and this is basically telling us that this business is the momentum in this business is growing. So each quarter they're able to grow at an even faster pace. Annual earnings growth is again telling you that this business has been working for some amount of time. So over the last 3 years is what we look for, and based on our studies since 1980 to 2000, the best winners have fetched have fetched annual earnings growth of 25 to 30%. That is the kind of rate that we look for. When you have 25 to 50% growth, we see that the stock can have a move of 35% or more in their share price. Okay, so it is not really, we are not looking for 25% or 30%, anything above that will do. Really what you need to look for is try to find the ones that are better than everything else. So if something is having 25% and there are a lot of other companies in that same industry which are growing by 30%, 35% or more, then that's not really what we want to see. We want to see something that is leading the market, and uh, something that has the best earnings growth among all the other companies in that industry group. So how do we identify that? So we have a metric called EPS rank or EPS rating, which will evaluate the both current as well as annual earnings growth, and it will assign a rating which you can quickly identify whether this is one of the best in the market or it is somewhat mediocre. So we'll talk more about EPS rank and how to use that in the later slides. So for now, what I'll say is that what we're looking for is the earnings growth that is better than all the other stocks in the market. So higher the better is always what we're looking for. And as well, if we can see acceleration in earnings growth, that is also something that makes us very happy, and that's something that we look for in the stocks that we pick. So strengthening numbers. So when you're looking at any industry group, you need to be sure that there are a few companies at least in that industry group that are doing well. So it should not be like there's just one company in that industry group that has good ratings and good EPS growth. So if it is really a business that is doing well right now, then that will have good earnings growth in a few companies at least in that particular industry group. So all this you can find out in the evaluation tab in MarketSmith India. We'll talk more about the evaluation tab in the later slides. So coming to our examples, a lot of people think that if you see a sudden jump in earnings growth, say June's earnings growth was 18%, and suddenly in the September quarter, year-over-year earnings growth jumped to 21%. That will immediately have an effect on the stock price. A lot of people will see that and think that it is already priced in, and there is no point buying the stock now after the results have come out. But in fact, what we see is that even if you do have that jump in stock price after a good quarterly earnings coming out, the stock can still make a significant run. So what we have seen again and again in our historical studies is that these winning stocks, they make their big moves after their earnings has come out. So there will be big moves before the earnings have come out. People anticipating strong earnings will push the price up. But when the strong earnings growth does come out in their quarterly statements, you will see the stock going up even after that. So we'll look at examples here which will show you that even after reporting strong earnings growth, the real rally in the stock price started actually after we saw the strong earnings growth come out. So the first example here is Page Industries. So it's not like you're going to be late by waiting for earnings to come out. Don't really buy just because there is an anticipation of strong earnings, because you never know what kind of quarterly report the company is going to come out with. Just make sure that those anticipations, the whatever the market is uh, anticipating, is able to the company is able to deliver that. So we want to be sure that the company is able to deliver. So that's why you always wait for the earnings to come out. So here you can see this kind of run was made after earnings, after the stock reported accelerating earnings and sales growth. And as you can see, since the bottom of 300, the stock did rally a lot significantly. So it rallied more than 100% from here. But even after that, as earnings and sales growth accelerated, the stock continued to rally even further. So this is another example of EPS growth happened right before the stock broke out in this case. So it was displaying negative year-over-year earnings growth. There was no not really some fundamental characteristics that we like in the stock at this point in time in the December and March quarters. But suddenly in the June quarter, it reported positive earnings growth, 21% year-over-year. Uh, Whereas the previous quarter was minus 11%. So this is a significant change that we see here. And as well in the next quarter also, there was a good acceleration in earnings growth, 21% year over year, accelerated, and it became 63% year over year. And if we look at the past 3 years earnings growth, it was 57%. So there was a good annual earnings growth happening. And in the quarterly growth, the negative growth suddenly became positive growth, and that further accelerated. And that had an effect on the stock's price. So after this accelerating earnings growth, that's when the stock really started to take off. So again, if you see from the bottom of this cup, the stock actually rallied around 26% before reaching its pivot price. So someone might see that and think that the stock has gone up about 26% in a span of a month or so. So that means that everything is already priced in, and this earnings growth that suddenly happened is already priced in. But in fact, what we see here is that was not true. So after that earnings growth, the stock broke out and it made a significant run after that as well. So why do we see this happening? The reason we see this kind of thing happening is because the market is assigning an even higher PE to the stock. So while the stock had declining earnings growth, the market was assigning a particular PE to it based on the historical quality of the business and the future prospects. But when all that started to become a reality, uh, when the earnings growth started to become a reality and everybody was seeing that they're able to pull off that business model very well, and they're able to deliver on what they had promised on and what the market was expecting, that means that investors will assign an even higher PE to that stock. So the quality of that stock in the eyes of most investors will increase. So that's when the PE ratio increase. So PE re-rating happened. So people were assigning an ever higher PE to this because they were able to deliver accelerating earnings growth, and that led to this kind of huge run. So we'll talk about PE and how exactly do we use PE when we buy our stocks and when we use our purchase decisions. So we'll talk a bit more about that in the following slides as well. So here is another example. This is the kind of earnings growth that we saw before the breakout happening. So the earnings growth as of the March 2013 quarter was minus 24% year over year. In the June quarter, that became 132% year over year, and in the September quarter, it was 85% year over year. So you can see there that this negative earnings growth turned into a positive earnings growth. So that is something that we really like to see in the stocks that we pick. So here is what happened. So again, you can see from the bottom, it has rallied a lot, but that does not mean that everything is already priced in. In fact, once the earnings growth started to come in their quarterly statements, after that you had this kind of huge run. So the big run happened after all the expectations became a reality. And whereas the small run, which causes everybody to think that all the news is all priced in, that was the anticipation run was quite small compared to the run that happened after the real earnings growth started to come in. So it's not just about earnings growth. A sustainable business will need to grow its sales in conjunction with its earnings. So earnings growth can be driven by cost cutting, but you cannot cut costs forever. And at some point, you have to increase sales as well. So if you can see earnings and sales growth happening at the same time, that is what we want to see following our methodology. So our methodology has a C and an A, and both the C and an A talks about earnings growth as well as sales growth. We want to see earnings growth happening in conjunction with the sales growth as well. So if we can see 25% or higher sales growth in the latest quarter, or if we can see accelerating sales in the last 3 quarters. So year over year sales growth is accelerating over the past 3 quarters. So that is something that we see that we think is ideal. So if we can see 3 quarters acceleration in earnings, and that is backed up by 3 quarters of acceleration in sales. So that's really telling us that this business model is really coming into steam in the current environment, in the current economic environment. It's working very well, and so that's what we want to see in the stocks that we pick. So here is an example of Page Industries. You can see that earnings growth was accelerating. June 2012 quarter, it was 18%, and that steadily accelerated to 38% year over in the quarter of March 2013. And at the same time, you can see that that was backed up by sales growth as well. So while earnings was accelerating, sales growth was also accelerating along with earnings. So you can see sales growth moved from 24% year over year in September 2012 to 37% year over year in March 2013. So there was big EPS growth before the breakout, and that was the backup for that was that there was strong sales growth behind that as well. So EPS growth was just not solely based on cost cutting; it was also based on sales increasing at a steady pace, accelerating sales growth. So here you can see there was a huge gap up after that quarterly earnings and sales growth for that particular quarter that we saw earlier, the March 2013 quarter. So after that particular quarterly results was released, you can see a huge gap up, and then there was a big run in the stock price. So you can see after this huge gap up, there was in fact a slight pullback. So this kind of pullback might cause people to think that everything is already priced in, and this gap up has already priced in everything, and there's not going to be any further run. But you can see in fact that earnings growth, that acceleration in earnings growth over the 3 quarters, as well as acceleration in sales growth over the past 3 quarters, coupled with over the past 2 or 3 years, there was steady growth in sales and earnings. All these factors are pointing towards a business model that is really working for some time, and it is really coming into effect at this particular time. So you can see that this business model is really starting to take off after that particular quarter. So when you see that, that's not the time to sit idle. So when you see that this business is starting to work, starting to fire on all cylinders, so that's when you can see this kind of run happening. The stock is really going through a big rally, and investors keep assigning an ever higher PE to it because they think that this is becoming a very quality business. So another example of Granules India. Here we saw that earnings growth accelerated from a negative earnings growth of minus 24% year over year to a positive, very strong positive earnings growth of 132% and 85% year over year over the next 2 quarters. And at the same time, this earnings growth was backed up by sales growth as well. So you can see that sales growth went from only 9% year over year in the March 2013 quarter, and it became 52% year over year in the September 2013 quarter. So earnings growth picked up, and behind that earnings growth there was strong sales growth as well. And what happened to the stock? So this was after those after that particular set of results in the September 2013 quarter. That's when the stock broke out from here, and it made a huge run after that. So once everything is in place, it's breaking out of a right chart pattern. The earnings and sales growth is telling us that this business is working very well in the current environment, and it has been working well in the past few quarters and few years. So that's telling us that this business model works, and that leads to a kind of big price run. So yet another example, this is Rajesh Exports, where you can see that negative earnings growth started turning into positive earnings growth. So it was negative, earnings growth was negative for some time. It became positive, and then it started accelerating from there. So when we see this, we immediately look at sales. So is this kind of acceleration supported by the sales as well? And in fact, we do see that that was the case. So there was acceleration in sales growth in the prior quarters, shows that before this earnings growth happened, so there was some sales growth happening. So sales was accelerating prior to earnings accelerating, and at the time of earnings also there was it was supported by you don't want to see this kind of earnings growth happening on negative sales growth. If it is at least a stable sales growth, that means that there is the business is being sustained. So that's so what happened to the chart? So the stock broke out actually after you see the accelerating sales growth here. Here you see accelerating sales growth moving from negative year over year growth to a positive year over year growth, and then further accelerating from there. You can see that sales growth accelerating did lead to a breakout, and here the earnings growth also helped the stock move up. So after the earnings came out, there was a big breakout. It did consolidate for some time, but that does not mean that everything is priced in. If the fundamental story is in place, then that chart is in all likelihood is going to move higher. So moving on to price to earnings ratio. So we talked about PE re-rating briefly. Uh, a lot of people, what they will think of is if the PE is very low or under 10 typically, they'll say that it is an undervalued stock, and that means that it's a bargain stock, and so that means that it has to go up. So people fail to realize that something that is undervalued can remain undervalued for a very long time. Now, the reason for that is that there may be very good reason for the stock to remain undervalued. So what we see based on our historical studies is that the conventional wisdom that anything with a low P is a good investment is not supported by facts. So just because the P is low, that alone does not mean that it is a good investment. So we want to see stocks that are that have a good business model in place. So when we are talking about growth stocks, that's what we want to see: stocks that already have a good business model, and their business model is working for them in the current economic environment. So if we are looking at those kind of stocks, which are quality names, which have good business models that are making profits for them, then typically they will not have a very low PE. In fact, they will have a PE that might seem high. So you might see that we see that leading stocks have a PE of say around 36. Around the study over this period that we conducted, at that time the leading stocks had a PE of about 36, and their P's expanded and reached around 80s during their run. So here is what we see the expansion of PE taking place. So PE was already somewhat high compared to other stocks in the market, and it was somewhat high because it had a few quarters of strong growth and a few years of strong growth, which indicated that it was a quality name that was able to prove that it was a sustainable business. And as the growth accelerated and they came out with better and better quarterly earnings releases, their PE actually expanded and became very high. So what looked high at 36 actually expanded and became even higher. Why did it become higher? It's because investors really believed that these were really quality businesses. So when the quality of the business, the perceived quality of the business becomes higher and higher because of the consistent growth in sales and earnings, that's when you will see the PE really expanding, and these can fetch you kind of big returns in a shorter period of time. So here are some Indian examples as well. So Aurobindo Pharma, before it made a big run, it had a PE ratio of 51, and then later from there the stock price went up by 313%. And whereas Bharti Airtel, at the time of that breakout Jan 2008, it had a PE of 122, and that stock went up so much since then. So Jan 2008 to December 2015. So there was a big run in the stock price. So the point here is that higher quality stocks will fetch a higher PE. Higher quality stocks do cost more, and growth stocks will have high PE because they deserve that high PE because of their strong earnings and sales growth in the recent past. And if they're able to sustain that level of strong growth, and if their growth is able to accelerate, then investors will reward that stock with an even higher PE. So you cannot you cannot buy a stock that has a low PE and think that it may happen that a quality stock may have a low PE, that there may be hidden gems in the market, but that is quite rare. And if you're trying to focus on quality stocks, you should not be afraid of buying stocks with a very high PE ratio, provided that it is supported with the strong earnings and sales growth, provided that it meets the C and A conditions of the canceling methodology. So in the prior slides, we talked about why we talked about earnings growth, why it is important for growth stocks, and how we try to always look for accelerating growth in earnings, supported by accelerating growth in sales as well, especially over the past 3 quarters, the most recent quarters. We want to see some kind of accelerating growth happening, and we look at the past 2 or 3 years as well to see whether that business has been able to sustain a steady pace of growth over the past few years. Uh, now we've talked about what we look for, and now we'll talk about how do we identify all these things using the MarketSmith application.
So there are few features and features that enable us to evaluate stocks which are showing strong fundamentals. Basically, the app as well as the web tool has all these features which will enable investors to evaluate stocks that are showing good EPS as well as sales and earnings growth. So some of them are EPS rating. It's our proprietary rating which will help us evaluate stocks which are doing high on EPS. And there's another evaluation tab which will help you check what are the other stocks in that group or industry which are doing well. Also, you can look at the price volume action of an individual stock on the app. There are also Indian stock list which will help you see the overall market picture and how a stock's doing in the market.
So one of our main ratings that we use is called the EPS rating. EPS rating basically compares, it looks at year over year EPS growth. It compares the most recent quarters to all the other companies in the market. So it looks at the past few quarters as well as it looks at earnings growth over the past 3 years as well, and it compares all this to all the other stocks in the market and then assigns a rating to it. So it goes from 1 to 99, 90, so it's kind of like a percentile rank. 99 would be the highest, and if you see an EPS rating of 99, that means that it beats all the other stocks, 99% of all other stocks in the market in annual and recent quarterly earnings. So in when this EPS rating is calculated, it gives more of a weight to the more recent quarters, but it also considers EPS growth over the past 3 years as well. So it is taking all the characteristics that we look for: accelerating growth, growth over the recent quarters, growth that is sustained over a few years, and then assigns all that to a single rating. And it ranks all the stocks in the market based on that particular rating. And the higher you see an EPS rating, the better it is in terms of earnings profile. So what we see is that most of the winning stocks will have an EPS rating of 90 or higher, at least 80, but most of the big winners will have an EPS rating of 90 or higher before making their big runs. So we'll talk about where to find EPS rating and how to use that.
So when you open up a chart, basically you'll find the EPS strength, which shows the EPS rank of a stock on the left corner of the ribbon, basically. So this is where you can find the EPS rating. This will enable us to see how the stock is been performing in terms of its earnings. So this is one of the very important proprietary ratings which we have, which will easily, basically the investors can easily find out the stocks which are strong with their earnings. Also, there are other ratings like price strength, buyer demand, and group rank, uh, which will help evaluate stocks based on their recent performance. This EPS rating is basically updated on a daily basis, and all these proprietary ratings, depending on how the stock has performed in terms of price as well as volume, will be updated. However, the EPS rating will be updated only on a quarterly basis, as and when the company reports its earnings. Moving on, there's another tab. After the evaluation tab, you have another tab for related, wherein we have all the stocks within that group. With this tab, it will help us to evaluate which are the stocks which are doing good within the industry. As Arun has mentioned earlier, it is important to have other companies within the group performing well as well. It is not that the only company within the group is doing exceptional while the other stocks in the group are not performing well. So this will be like this is always remember, stocks move in direction of the group. So it is very important to check how are the other peers within the group performing before we take an investment decision. So this related tab in this app will help us evaluate how the other stocks are doing within this group. Over here, if we see Isha Motors, Force Motors, and all, we can compare the master score here as well as their RS rating here. The next tab which we have is the checklist tab. It is a quick, this tab will help us check the CAN-SLIM criteria basically. So if we want to check Isha Motors, how far is Isha Motors meeting the CAN-SLIM methodology, this will quickly help us check. This will quickly help us check how the stock is based on CAN-SLIM. So as long as the stock meets certain criteria, it will show us a tick mark, otherwise it will show a cross mark. So it is always ideal to have at least 60%, 50 to 60% above percentage in terms of CAN-SLIM criteria. There's another rank here, it's an industry group rank, so it is very important to check this rank as well. So it is very ideal to have a group rank lesser than 40, above 40 is not preferred. So always keep an eye on this group rank, because group ranks keep changing on a daily and weekly basis. Basically, this shows the industries which are outperforming the other industries within the group.
So industry group rank is measuring the performance of that stock, of that particular industry, relative to all the other industries present in the market. So the lower the industry group rank, that means that that particular industry group is rallying in the market. Whereas if it is a high industry group rank, it means that this particular industry group is not rallying in the market. Also, price strength is similar to relative strength. Uh, just another name for relative strength. So it is telling you how the stock is performing relative to the benchmark basically. So it takes a benchmark of all the other stocks, and it sees whether the daily price movement of the stock is better than all the other stocks in the market are better than the benchmark or less than the benchmark. So if it has a good price strength, that means that this stock is leading the market and it is one of the best performing in the market at this point in time. Buyer demand, a little bit similar to price strength, but buyer demand takes volumes into consideration. So if the buyer demand is high, that means that when the stock goes up, it goes up on higher volume, whereas when the stock sells off, it sells off on low volume. So there is a lot of buying demand, whereas the selling demand is not much. So what that is telling you is that there is more of money inflow into the stock. So it could mean that institutions are buying this stock. So when you see that the price is going up on high volume, whereas when the price goes down, it happens on low volume, what that is indirectly telling you is that institutions are buying the stock and there are a few investors who are getting out. So when this kind of thing happens, you will see that buyer demand will have a high value. So it's telling you that there is more money flowing into the stock rather than flowing out of the stock.
So another way you can find out basically the stocks which are doing good in the market is the idea list section. So you on the home page, as soon as you log into the app, you'll find a section called idea list, wherein we'll have all the stocks which are doing good in the market as well as the stocks which are there in our model portfolio. So when you enter this section, you will have a number of filters basically. So in this, there are numerous subsections. There is a section called Top India 47 stocks. So this is the IND 47 index. This index keeps changing on a weekly basis. This index basically takes all the stocks which have shown a high price volume action in the recent past. So this is updated on a weekly basis. However, most of the stocks remain same. But on a weekly basis, we might find a few changes, removals or additions to this IND 47 list.
So just to recap, we had mentioned earlier, but just to recap, IND 47 is an automatically generated portfolio. So there is no human intervention in this portfolio, and it just picks up stocks and removes stocks from this portfolio based on the characteristics that we have set, and it does so automatically. So it's a completely computer generated portfolio. So buyer demand can be seen in the evaluation section. So if we go back a few slides, you can see buyer demand here. EPS strength, price strength, buyer demand, group rank, all these ratings directly show up on the chart in the evaluation section as well. So in one place, you can see all of them together and you can make decisions based on that.
So under this, we also have a selection of top stocks near buy point. So this selection basically enables us to see what are the stocks within the IND 47 index that are trading near the buy point. Buy point is ideally 5% from pivot. So the stocks which are broken out of basis consolidation patterns, the stocks which are trading within 5% from its breakout from its pivot. So that are the stocks which are going to show up on this filter. The next section of this is the current holdings part, wherein we add and remove stocks based on its performance. So we basically do the fundamental and technical analysis for the stocks, and we identify stocks which have good growth potential and which may have a good run in the future. So here in this section, we find all the stocks which are currently in our model portfolio. So within this section as well, we have a current holdings near buy point filter, which enables us to see all the stocks in our model portfolio that are trading close to their buy point. So as I told earlier, the buy point is nothing but the stocks which are trading within 5% from its pivot are the stocks that are going to show up in this filter as well. There's another option for users which they can select. It is basically the users list. It is a customized. Basically, a user may want to tweak in his or her own filters. So this will help them weaken the filters and filter stocks based on their own criteria. You can maybe give a higher EPS rank, or else you can also discount the EPS rank a bit and then given these filters. So this user filter will enable us to basically select all the filters which we want to see for the stocks.
So I think we had a few technical difficulties earlier where I think the presentation was freezing as well. So I'll go over once again the gist of what we talked about today. Uh, so So the main thing that I hope we can take away from today is that it's really important to look for uh, earnings growth in any stock that we look for. So remember that we are looking at growth stocks when we talk about the Canceller method. So when it comes to growth stocks, we want to see growth happening in the most recent quarters. In the most 2 quarters or more, we want to see some kind of strong growth happening. 25% year over year growth or more is what we look for. And especially if we can see this type of earnings acceleration where the year-over-year growth rate in earnings is accelerating each quarter. This is something very positive, and this is always something that we like to see. And of course, earnings growth rate should not be just for the most recent quarters. We want to see earnings growth happening over the past few years as well. So why do we see the few quarters and in the few years? Few quarters because we want to see whether this business is able to fetch strong returns in the current economic environment. So we want to see that this business model that the company is doing or whatever the company is doing right now is working for them at this point in time. And at this point in time, they're able to grow their earnings. And we look at the past few years to be sure that this business has been able to grow in the past few years and their business has been able to sustain itself for more than a few quarters. So it's a sustainable business model that has been able to grow earnings over a few years at least. So that's why we look at annual earnings growth also. And of course, earnings growth should not be on its own. Earnings growth also has to be coupled with sales growth as well. So if we can see earnings growth that is backed up by sales growth, uh, so that is something that we always like to see. Uh, if we can see 3 quarters of acceleration in both sales and earnings, that's really the ideal thing, and that's what we always try to look for when we look at the fundamental characteristics. Why do we want sales growth? Because like we mentioned, earnings growth on its own cannot be sustained for a long period of time. If we want to be sure that this is a sustainable business, then that earnings growth uh, has to come on the back of very strong sales growth. So we looked at a few examples where we said that just because they come out with a strong quarter and then the stock suddenly jumps, that does not mean that everything is priced in. So if you do have consistent growth in earnings and sales, that stock is going to have a big run and it's going to fetch a good amount of returns for a good period of time, and that momentum is going to carry it for some amount of time. So now why does this sort of thing happen? That is because what we are trying to catch here when we catch these kind of big runs is really the PE re-rating. So good quality stocks will have what seems like a somewhat high PE rating, say 25-30 PE rating. And when their earnings starts accelerating, like you can see here, when you can see that they start accelerating their earnings growth and accelerating their sales growth, investors will keep assigning an even higher PE to them because the perceived quality of that stock is increasing in the market. So people think that this is a really good growth idea, and when people believe that it's a good growth idea, people will assign ever higher PEs to that stock. So don't be afraid of what looks like a high PE now, like Aurobindo Pharma, which had a PE of 51 before it made this big run. Uh, PE can always expand as the business proves itself. So as they come out with good numbers, their PEs can actually expand from what already looks high. And then we talked about how to use EPS strength, the rating that combines quarterly earnings growth as well as annual earnings growth into one rating, and how it shows up on our application and how you can use that with our tool to quickly pick up the stocks that have the the best earnings growth. Okay, so this slide talks about just what I just mentioned right now. Uh, I think what we need to understand here is that we should not be settling for the stocks that are just okay or that are just of low quality. The canceling methodology, when we're looking at very high earnings growth, accelerating earnings growth, coupled with accelerating sales growth, there are not many stocks that will fit that kind of criteria. So we need to have all those things in place, and that's when we pick the biggest winners in the market. And like, in the same way, when we are talking about industry groups, we want to pick the industry groups that are doing best in the market, and we want to pick the stocks that are the best within that industry group. So cancel method is all about picking the best of the best when it comes to growth stocks, and keep in mind that there will not be many that fit these criteria. So just because you don't see too many stocks that fit with these criteria, be patient. When you do find something that fits into all these conditions, so that's really when you have a big winner in your hands. So coming to the different tabs in the application, so mainly what you see is this evaluation tab. So evaluation tab will have this chart with all the main ratings that we talk about. So so it is telling you the chart pattern. You can see the volumes here. You can see a daily, weekly, and monthly chart based on the settings, and you can see all the main ratings that we look for. So if you're going to look at only one tab, I would say that look at the evaluation tab, because it's giving you the market score, the master score, EPS strength, price strength, buyer demand, group rank, as well as the chart, everything in one view. Uh, so this would be the main tab that you need to look for. And for doing more detailed research, you can look at details tab, where details tab will tell you a little bit more details about the fundamentals of that company. So you can see in detail what is the earnings growth in the past recent quarters. And related tab is telling you what are the other stocks in that industry group. So you can compare this particular stock to all the others in that industry group and see which one is the best. And in the checklist, you can see how well does it fit within all the cancelum characteristics. So you can see that these are the conditions that these are basically the filters that we use for the cancelum method, and you can see how well it fits in with our filters. So you can see that this particular example, it's 66% fits in with all the filters that we use. So 6 out of 9 of them are passed. So that's why it has a 66% fit in this particular screen. So I see somebody talking about intraday trading. So what we generally advise is, when we talk about our methodology, we're trying to put forward a methodology that is both easy to learn as well as easy to apply as well. So we are not talking about valuation or those kind of things. All we are talking about in fundamental characteristics in today's session, all we talked about is earnings growth and sales growth. So that's not very hard to figure out, and that's not very hard to see from their income statements as well. So, but just because it's not complicated does not mean that it's not powerful. So what makes a business a good business is basically how quickly they're able to grow their sales and how quickly they're able to grow their bottom line. So that's basically what identifies a good business. And of course, we'll talk a little bit more about different fundamental characteristics in future sessions. But really, it's all very basic fundamental characteristics that we look for. So we identify stocks based on fairly simple criteria, and the technical chart patterns that we use are also fairly simple. So we talked in our prior sessions. We talked about Compass handle, flat base, all those chart patterns. They are fairly simple compared to what intraday technical traders use when they are looking at charts. So in the end, it is something that is it is simple to learn as well as simple to apply as well, which is why we really uh, advocate this particular methodology, especially for retail investors. Uh, so that said, as a retail investor, you always have that information disadvantage versus institutional investors and versus the seasoned intraday traders. So those seasoned traders and the big investors who hold stocks for a very long period of time, uh, so the big investors who hold stocks for a long period of time, they will have a much better picture of the fundamentals compared to a normal retail investor, whereas the intraday traders will have a much better technical picture compared to a normal retail investor. So both those ways it's kind of hard to beat them. So the only way you can beat them is to is to look at the basic things that make a good business. So if it is a good business, there is no reason that the stock is not going to go up, provided that that momentum is there in terms of chart pattern and in terms of accelerating sales growth. So we try to identify based on Cancelim those businesses that are good growth businesses, and based on charts and based on market direction, we try to time the buying decision at such a time so that we can get the maximum amount of gain in a minimum amount of time. So that's all that the methodology is about. And I see a few more questions about IND 47 and what kind of turnover does the IND 47 portfolio have. Uh, it really varies on how quickly the market is changing. So if it is earning season, there may be a lot of stocks coming out with great earnings. So that could mean that a lot of stocks get added to the IIT 47 portfolio automatically. Because their earnings growth turned out to be better than all the others in the market, as well as when the market is weakening, when the market is really starting to weaken and technical characteristics are starting to get very bad, then you can see that there may be quite a few removals from the IND 47. So how many additions and how many removals can vary a lot, but typically I would say that around a 4 or 5 each week would be the churn in the IND 47 portfolio. So we try to make sure that there are always 47 stocks in that portfolio, no more and no less. So when something gets added, that means that something has to get removed as well. So that means that in IND 47, just because we want to have the number as 47 stocks, that would mean that automatically there is a little bit more higher churn compared to our model portfolio. So I hope everybody was able to learn something from this session. So the key point here is that when we talk about fundamentals, we are looking at very basic things, things that identify a strong business in that they are able to grow earnings and sales in the current environment very well. And we buy those, once we identify those kind of stocks, we buy them based on the timing criteria that we talked about in our prior sessions, like the right basis, the right market condition, and so on. And today we talked about PE as well. So it may not be a wise decision, especially when we are trying to identify growth stocks. It may not be a wise decision to only buy stocks with low PEs, because more often than not, a growth stock will have a PE that already looks high, and then it's only going to accelerate from there. So that's all for today's session. I guess fairly simple session today. Not too much details about charts and technicals. It's just about the basic earnings and sales growth that I think many of us would already be familiar with. So all that I wanted to say today is that it accelerating earnings and sales growth is something very easy to look for, but it is at the same time it's something very powerful as well. So when you see that kind of accelerating earnings and sales growth, that is telling you something, and that's not something to be overlooked just because it is something very simple. So that's for today's session, and in tomorrow's and the next session, in the next to next Tuesday, which we'll have, we'll talk a little bit more about fundamentals. We'll talk about ROE and why ROE is important, and we'll talk about profit margins as well. And we'll talk about how margins can vary from industry to industry, and why it's important to keep margins, to look at margins while keeping in mind what kind of industry that stock is in. So so there's going to be more about how do we identify stocks. I'll say now itself that there is nothing too complicated that we look for when it comes to fundamental characteristics. It's all just very simple criteria that we look for. All we are trying to do is to identify those businesses that have very good business models, and they're able to grow their business very well. And once we identify those type of businesses, then we just it all comes down to timing and when exactly do you want to buy that stock in order to fetch the best returns in the minimum amount of time. So that's all for today's session, I guess. I'll pause now and I'll take any more questions that you might have. And once we're done with the questions, we'll close it for today. Okay, so for looking at earnings growth, there are two ways that you can go about it using the application. Uh, the easiest way is just to look at EPS strength. So EPS strength is a combined rating that takes into account the most recent quarterly year-over-year earnings growth as well as earnings growth over the past few years and combines it into a single rating. So it's basically a percentile rating that goes from 1 to 99. So 99 is kind of like 99 percentile, which means that it's better than 99% of all other stocks in terms of earnings profile. So that is the easy way of looking at the stocks that have great earnings growth. If you want to go into a little bit more details, you can look at the details tab here, where you can actually see what is the year-over-year earnings growth for that particular stock, and then you can see whether it's accelerating over the past years, past few quarters, how much is it accelerating, is it more than 25% or not more than 25%. So details you can see here where it will give you details about the actual fundamentals, but the quick way would be just to look at EPS strength rating. So avoiding traps like Satyam and timing your buying and selling decisions, we had actually gone over in more detail in our prior sessions where we had talked about all the technical things that we look for when it comes to our methodology. So we had mentioned how do you look at prices in conjunction with volume. So when we see the stock going down on high volume, that could be a sign of institutional selling, and so many details that we had gone through before. I think all those prior webinars would be uploaded on YouTube where you will be able to find them, and if you go over those, I think it will be a lot more clear to you on both how to time buying and selling decisions and how to avoid situations where a stock can suddenly tank. Now we have to keep in mind that you cannot time everything perfectly. There may be a stock might tank suddenly, but the key there is to identify that it has tanked for a particular reason, and we need to identify that in the chart. So we need to look at the chart and see that yes, something has changed now, and something has seriously gone wrong, and we should get out now. So that's something that we need to identify looking at the chart, and that will save us from even further losses. So yes, EPS strength will in fact it will filter out the companies that have the best kind of earnings growth compared to all the other stocks in the market. So if you see something more than 90, that really means that the earnings growth for that company is very strong. Group rank is again it's based on uh, prices. So group rank looks at that particular industry as a whole, and it compares the price movement of that particular industry group compared to all the other industry groups in that market. So if you see a good group rank, that means that that particular industry group is performing well in terms of price performance versus all other industry groups in the market. So if you're trying to find stocks which are within the base, you can just have a look at near pivot. You can look at the near pivot section in our application, which is, yes, you can see here top stocks near buy point. This is automatically going to give you stocks that have good EPS ranks that are nearing their ideal buy point. And also, if you look at current holdings near buy point, this is basically out of our model portfolio. So it's basically from our model portfolio. So that means that we have already looked at the story of that stock and looked at its earnings and sales growth and decided that it's a good investment. So if you look at our model portfolio and then go to current holdings near buy point, that's going to tell you those fundamentally strong stocks that we have already identified and are now once again coming near a good buy point. I see another question about companies with huge dividend payout that but are low priced. So the thing to keep in mind here is that with our methodology, we are looking at growth stocks. Now, when it comes to growth stocks, most of the return is going to be in the form of capital appreciation. Like how we mentioned earlier that the PE of the stock is going to expand as the earnings growth accelerated as the earnings growth accelerates. So most of that return is going to come in the form of capital appreciation. Now that said, it's not that other strategies are not valid, and of course we can look at companies that have good dividend payout but are low priced. Now that would be a good investment if you're trying to look for a regular stream of income from your portfolio. But those are not really, we don't really term them as growth stocks. Those are, it's a dividend yield type of strategy where you try to identify companies that can consistently pay dividends over a very long period of time. So it's a completely different strategy that you're talking about when you're looking at dividend yield, and it's not really, it doesn't really fit with what we look for when it comes to canceling. So IND 47, it basically it refreshes its portfolio each week. So each week at the end of the Friday, before the market opens on Monday, there will be certain stocks that are removed based on the action that happened through the week, and certain stocks that will be added based on the action that had happened through that week. So it's just at the end of the week that the additions and removals take place for IND 47, which is again different from our model portfolio where we add as we identify good companies and as they break out. Okay, so another question about diversification. I think we mentioned this in one of our earlier sessions as well, is that there is a very good quote by William O'Neill which says that diversification is basically uh, a hedge for ignorance. So don't try to over diversify your portfolio. So what we find is that the best fund managers who trade stocks, and what we try to do with our methodology as well, is we try to identify the best of the best. So based on both fundamentals as well as timing using technicals, we try to identify the stocks that are the best in the market right now, and then we stick to those limited few. So what we generally advise is that you should not be having more than 4 or 5 stocks in your portfolio. So you pick your investments based on what really looks good. So you pick the best of the best, and then you bet big on those. So that kind of strategy is going to fetch you those kind of huge returns. So for example, if you have 20 stocks or 30 stocks in your portfolio, and one of them turns out to be a stock that fetches 100% returns. So just because it's a small part of your portfolio, that means that it's not going to grow your portfolio much. But whereas if you properly pick 3 or 4 companies, and all 3 or 4 of them go up by 25-30%, that means that your portfolio has already given you a really strong gain. So we are very much believers in concentration rather than diversification. So what we say is you pick your stocks well, and once you pick them well, you bet big on those. So yes, in model portfolio, we in fact add as the stocks break out. But for IND for 47, it really works in a different way. We run that algorithm basically on a weekly basis. So we don't really run it each day. We just run it at the end of the week when we have all the data that we need for that entire week's trading action. So that's why for INT 47, stocks get added and removed only at the end of the week. So yes, if you find the stock that has already gone up, so already gone up, I'm assuming that you are saying that it has already gone up from an ideal pivot price or an ideal base pattern where you identified the pivot and it's extended from that pivot price. So in that case, we always suggest that we wait for the stock to correct and come back to the pivot price. Or if that does not happen, you can actually wait for the stock to make the next base, and as soon as it breaks out from the next base pattern, we buy it then. So how we go about things when it comes to our model portfolio is that we will keep screening for stocks that have good fundamental characteristics, and we'll have those in our watch list. So once we have a watch list of stocks that we like from fundamental standpoint, then we'll add them to our portfolio once we believe that the timing is correct. So when it breaks out and when the market is in a good conditions, when the market is in a rally, so that's when we add them to our portfolio. So it's just like you've already identified stocks that are look good, and then you're just waiting for the right time to enter into those. So for IND 47, we don't really have alerts. We just have here it shows up in the app what are the recent additions and what are the recent removals. So if you just check it on every Monday, you will automatically be up to date with whatever is happening in IND 47. Okay, it looks like that's all for the questions that you have for today. Uh, I hope you enjoyed the session, and I hope you learned a little bit more about our methodology. And we hope to see you next time. So keep in touch. In another 2 weeks' time, we'll have another session where we'll talk a little bit more about fundamentals. And I'll just mention once again that it's not really very complicated characteristics that we look for. It's all very basic things, and all we're trying to do when it comes to fundamentals is we are just trying to identify a business model that works. So that's what we try to look for, and then we base our buying and selling decisions based on the technicals. So that's all for today. Thanks again for joining us. So thanks, and do check out our application if you haven't already. You can find it on Google Play. Thank you, and have a nice evening.